Hello, everyone. I am Brady Bridges, and I'm the broker and owner of Reside Real Estate here in Fort Worth, Texas. I want to welcome you to another episode of Real Talk with Reside Real Estate. We are a top producing team here in Fort Worth, Texas, and we want this podcast to be a resource for anyone looking to learn more about real estate and the great city of Fort Worth, Texas. Today, I'm joined by Tony DeYoung. Tony is a partner at Desroches Partners in Dallas. He is a highly experienced public accountant who has provided tax and financial advisory services to various industries for over 14 years. Tony works with his clients to optimize their federal and multi-state organization, reduce compliance costs, and minimize tax liabilities. He has a vast experience in working with private equity, real estate, investment partnership, and financial services organizations. Well, Tony, thanks for coming in.
Thank you for having me on, Brady.
So one of the things that I'm always getting asked about, people on our team, whether it's individual real estate home buyers or investors, they're always asking about their taxes. And obviously, we're real estate agents, brokers. We can't talk about those things. So I'm really excited to have you in. If you could, go ahead and just kind of tell everybody a little bit about yourself and how you got into accounting and your background.
Yeah, so I was born and raised in Shreveport, Louisiana. I went to college at Louisiana State University in Baton Rouge.
Go Tigers.
I actually finished up at LSU Shreveport. Funny story, my grandmother started a bookkeeping business way back in the day. My mom then took it over, and then I always said that I wasn't going to go into accounting.
Here you are.
And so I actually started, my college career in pre-med. And so after sitting through organic chemistry, I think I needed to make a change. So I switched to accounting. I graduated in 2008 and moved straight here to Fort Worth. Just kind of wanted to get into a bigger city and start my career, the way I wanted to do it. And here I am now as partner at a very prominent firm in Houston and Dallas, and loving every minute of it.
Yeah, it's been, so backstory, guys, Tony and I have been good friends for a while, and it's been really exciting to see your career grow and progress, even though you had to move to Dallas to get it done.
Yeah, no, it's been fun. We've been growing in this career or in our careers together. So it's been great to see you.
It's what you hope for all your friends,
built,
right?
It's great to see what you've built here yourself,
Well, big part of it's the team here. So when you came into Fort Worth, did you jump right into the type of work you're doing now? What did you start out doing?
I was really a generalist. I got into public accounting. I knew I wanted to be in public accounting. Got in on the tax side, very early on. And I just wanted to make sure that, I had experience in all aspects of public accounting. And that means all different industries, including real estate, investment partnerships, everything that you mentioned at the beginning, as well as, basically I've got most of my experiences in tax, but I've, helped with audits that, our firm is a full service accounting firm. And throughout my career, I have helped out with audits that are related to specific to tax matters and stuff like that. And even on the accounting and bookkeeping side of things, I've helped come in and look at businesses that are maybe struggling with processes and procedures and help get them, to where they need to be and get them prepared for whenever, they are getting teed up for an audit or their taxes. So I would say I'm definitely a generalist, but most of my clients are in some type of real estate related activities or, investment partnerships, stuff like that. So, it's just kind of gradually
and I'm sure,
to where I am
I'm
now.
sure it's kind of like our business. The longer you're in it, the more crazy opportunities and different industries come to you, right?
Yeah, it's word of mouth. People hear that I do a lot of investment partnership work. So, I get a lot of private equity clients. I just signed like 3 or 4 new private equity clients last week, and it's just been word of mouth of people kind of sending me work, and it's been great. That's what you want. That's what you want to get your name out there in the cities that you're working in.
So, as you know, primarily what we deal in is residential real estate, but we also have a lot of people, they're buying, and I would still say most of my investor clients and the clients we work here are buying residential real estate investments. So just kind of to get down to what we want to talk about is we're getting asked all the time, what do we need to do? You and I discussed this morning about with some of my properties, we need to like cost segregation studies. But let's just start at the basics. If you're just an everyday guy buying a home, in terms of tax implications, is there anything that we need to dive into specifically that they need to watch out for or they need to be aware of, either if it's on the before they buy or after they buy? Because I know, a lot of times tax returns are a big part of the qualification process. So let's just kind of start there and walk me through it from the accounting side or CPA. Sure. Like what do people need to do to get ready to buy?
Yeah. So I think let's start at the very basic thing of being a home buyer as your personal residence, right? Yeah. So you with a personal residence, there's really 2 to 3 main things to consider. Well, not really consider, but that you're going to have to deal with once you buy a property. The benefits that you're going to get from a tax standpoint are really going to be focused on your mortgage interest and your real estate taxes. And your real estate taxes, have now been capped by law to $10,000. So you kind of get to that number pretty quickly.
Especially around here.
Especially around here, yeah. So you're gonna get to the $10,000 cap on real estate taxes pretty quickly, and then you got to kind of look at your mortgage interest. Now, if you have a home if you have a mortgage that's under $750,000. You're not going to be limited on the mortgage interest deduction that you're able to take. When you get over that number for mortgage, you're going to have to start having some limitations. But those are the 2 things that you're going to have on a year-to-year basis with your personal residence that you're going to be able to deduct on your personal tax return. Now, when it comes time to sell your home, there's your personal residence exemption on gains related to the sale of your personal home. And so what that is it's a $250,000 exclusion for individuals and $500,000 exclusion of the gain for married couples filing jointly. And so basically what that means is if you buy a home for $500,000 and you sell it for $800,000 as a married couple, that $300,000 of gain is tax free. And so you can either either bank the money or you can roll it into another personal residence. But you have to have lived in your home for at least 2 years leading up to the sale. Anything less than that, you're going to have to pick up the gains.
Okay. So on the just primary residence side, there's not a lot more into it. It's you're pretty safe. There's nothing you need to worry about.
Yeah, it's pretty straightforward.
Just on a side note, on the qualification side, I had William, who did your loan, on here a while back. You need to make sure that you're filing your returns in time if you do want to buy, and that you're showing income. So if you're self-employed, make sure that you're actually showing income, because it's going to be really hard to go to your accountant after you've already filed and say, hey, I need to show $100,000 here.
Right.
So let's jump into the investment side, because that's kind of what I've been leaning into lately, because more and more people are asking about it. Real estate's, obviously, you've seen it over the past few years. Buying a house in Dallas has just gone crazy. Prices have gone up. Interest rates are up right now, but we're still getting people asking about buying real estate, and taxes come up. So if you're a real estate investor, what are you? We can start from we can go from a new investor to an experienced investor. So let's just say you're going to buy your first property. What are the things that you need to be talking about, or are the questions you should be asking your CPA about when you're buying investment property to make sure you set it up the right way? Because I found, just on the stuff we've dealt with, it's been very beneficial to come to you first, then have to work backwards. So if I was going to come to you and say, hey, Tony, I want to buy my first real estate investment property, what do I need to do? Yeah.
So that's a great question. The first thing I would do is educate you on the ramifications, on the tax ramifications and the tax planning aspects related to that type of transaction. And I would, encourage everyone listening to this podcast to always be proactive in reaching out to your CPA anytime before making a decision on a particular transaction, because it's very easy for the CPA to help plan on the front end and help the taxpayer be in the right position for the transaction. It's much more difficult to be reactive and have to go back and try to fix things that may not have been the best move.
Yeah, I've gotten the blunt of that, especially since we're close friends. You give me a really hard time when you're like, why did you not call me?
Yeah, I mean, and look, if you have a good CPA, they're not going to nickel and dime you on the tax bill. They're going to want to plan with you. They're not going to try to, prevent you from reaching out to them when you need help. Like that should be encouraged. And so the number one thing is educate yourself on the rules related to, investment real estate and stuff like that on the front end. And so basically what I would say is that it starts with the passive activity loss rules. So when as a new investor, I would imagine that this isn't your primary job. We can talk about materially participating real estate professionals in a little later in the podcast. But on the front end, if you probably have your normal everyday job or your business, and you're wanting to dabble into
that's most people that we deal with is they have another job, a good W-2, or they're self-employed, and they want to start building up something for later on down the road to have some passive income.
Yeah. So what you do is you've got to educate yourself on the passive activity loss rules and understand that real estate by nature is a passive activity. So that means that if you have net income at the end of the year, you're taxed on your net income. If you have losses at the end of the year, which most real estate activity does, be related to due to like depreciation and other operating costs that drop you. But even though you might be net cash flowing, from a tax standpoint, you probably could still generate a loss based on depreciation and stuff like that. And so what that means is if you have a net loss at the end of the year, you're not able to offset your ordinary income from like your regular job with the losses from the real estate activity, unless you have other real estate or passive income that can offset those losses. But I wouldn't be discouraged. You can carry forward those passive activity losses indefinitely until you either have passive income to offset it, or you sell the property and then recognize the losses at the point that you sell.
Okay. So obviously, you're not an attorney. Are you seeing a majority of people that are buying, like if they have one property, are you seeing those in their personal name on their tax returns, or typically are they putting those in like an LLC or something like that?
I would say most of the time, if you're buying an investment property that you plan to rent out, it needs to be in an LLC. Again, I'm not an attorney and can't provide legal advice, but from a liability standpoint, I can tell you want to put the property in an LLC. And you can put I would put each separate property in a separate LLC, and even though you can file all the LLCs on one tax return or on your personal tax return, it's good to have a property in a separate LLC.
Yeah, that's how I have mine set up in a series, is what they call them.
Yeah, exactly.
So let's just say you're acquiring property, continuing to grow. Mm-hmm. As you continue to grow, are there other things that come into play as you add property, or is it the same thing, just rinse and repeat every time?
It's kind of the same across the board. You kind of treat each property as its own separate individual like entity and activity, even though you might eventually be, what we call earlier, a materially participating real estate professional. At some point, you can combine all those activities and you can make your activity active. But you still kind of treat each separate activity individually and look at each one from its own individual tax standpoint when you're looking at the taxes related to it. And what I would say...
So what would that look like from an active standpoint? Does that mean you no longer are doing something else and that's your everyday job, or...
Yeah, so in order to become a materially participating real estate professional, there's like three like separate criteria that you have to meet. What I would say the main deal is that you have to have at least 750 hours a year with activities related to real estate, of you actually managing and working in the industry. And then not only that, you have to make sure that at least more than 50% of your total personal services that you provide during the year are related to the real estate. Yeah. Meaning that if you have another job, you have to have at least more time working on the real estate activities than you do on the other job. And so what that means is once you qualify as a materially participating real estate professional, you can now take what would be those passive losses that we previously discussed that are that can't offset your ordinary income, you can now treat that as an active activity and offset the income, your other business income or W-2 income.
This is why you need a CPA.
Yeah, it's very technical.
It
could be very difficult to get into the weeds on that. I mean,
would you say anyone that's owning investment property needs to have a CPA?
Absolutely, 100%. Just you could have a very simple one investment property, but at least try to reach out. I mean, you may not engage a CPA. At the beginning, you can maybe try to prepare your own tax return, but at least having the discussion with a professional at some point, just to bounce ideas and let someone know that you're see if you're going down the right path.
I think a lot of times, and I don't. Obviously, you've scaled up on your, but I think a lot of times I see people look at a CPA as the one time a year person they call when they need their taxes. And one of the things that I've really benefited from having you on my team, on Jen and I's team, is that it's strategy. There's a lot of strategy, whether it's a financial advisor, attorney. You sit down and make a plan. And I think most people that are buying investment properties are trying to. I mean, those are people that are trying to grow and scale. So I would definitely encourage anyone to reach out and start making a plan. If you do want to grow, it's good to have people on your team that can help you get there. And especially if they're seasoned in the industry, they know people that have done things and can give you advice and tips on how other people have been successful in getting to the level you want to be at.
Sure. And not only that, there's things that, how many people on this podcast have, heard of cost segregation studies? I don't know. I mean,
I was quizzing you about them this morning.
I know. I mean, one of the things that you can talk with a CPA about is getting a cost segregation study done on, if it makes sense to get a cost segregation study done on a rental property before you buy it.
So let's backtrack.
Yeah.
Tell everybody what a cost segregation study is.
Okay, so what a cost segregation study is you get someone who's certified to do this to come in, look at the property, and they basically take the home and they break it up into different segments, right? You have your overall structure, but then you have things such as countertops, appliances, carpeting, tile, fixtures, things of that nature that from a tax standpoint have a shorter depreciable life than the overall structure of a home. So the general depreciable life for a person or a residential real estate is 27 and a half years. Okay, when you're renting a property, you buy it, you place it in the service, you can deduct it over 27 and a half years. But if you get a cost segregation study done and you put the things like I had mentioned, the countertops, appliances, fixtures, stuff like that, those have more of like from a 5 to a 15 year depreciable life. And not only that, they're also subject to are eligible for bonus depreciation. And so what bonus depreciation is up until 2023, you were able to deduct 100% of the cost of that particular segment in the first year that you place it in service. Now in 2023, based on the Tax Cuts and Jobs Act and the law, that number is now down to 80%. So if you buy a rental property in 2023 and you place it in service, you get a cost segregation study done, all those assets that they can put in the 5 to 15 year category, you can deduct up to 80% your very first year that you place in service. So right there, you're already that probably will generate a loss on related to that rental property in year one. And so, if
how many people are you seeing do these?
Not enough. I think more people should do this. Again, like I mentioned before, it really depends on, is the cost worth it to you? If you buy a $250,000 property, does it really make sense to do it? Probably not. If you're buying a $2 million property, yeah, it absolutely makes sense to do.
So what would you say to a portfolio owner? Let's just say you have somebody that owns 15 houses and they're $200,000 to $300,000. Is it worth it?
Sure.
Do you think it'd be worth it at that point, or do you think I guess you're paying for each one separately, right?
Sure. Well, I mean, I'm sure that you can find some. We don't do cost segregation studies at our firms, but I think that if you find someone who does do, whenever you find someone who does do them, they can lead you in the right direction of what they would recommend. Okay, and most of them that I've worked with are very straightforward and honest on whether you need to get them done or not.
Okay, that's good advice.
Yeah.
So, kind of leading off of this a little bit, how do you're talking about, the new rules coming out in 2023. How do you keep up to date on all these changing rules? And obviously, I'm sure you have some mandatory continuing education, but how do you stay educated on all the changes? Because you're working in so many different industries.
Yeah.
How do you be sharp all the time on what you're working on?
Well, like you said, as a CPA, we on average have to have at least 40 hours of CPE every year. And, good CPAs will go and get their CPA or get their CPE in the industries that they work mostly in. And for me, that's real estate, investment partnerships, stuff like that. And thankfully, there are a lot of organizations out there that hold seminars and CPEs and stuff like that on specific partnership and real estate activities. So, for example, every couple of years I'll go up to Washington, D.C., where NYU holds a 3-day seminar related to investment partnerships and real estate. And, it's the education you get on that is just, you can't put a price on it because it's so good. They'll have professors that speak. They'll have IRS agents come in and speak, and other CPAs, attorneys, and professionals in the industry. And that's how I keep up with with the times.
That's awesome. Mm-hmm. So, working with clients, what are your favorite? I mean, I know sometimes you've told me it's not always fun doing this type of work, but what gets you excited in your job? Like, are there specific industries, or is it the strategy side? What do you really enjoy in your part? It's in the process?
It's really the interaction and the consulting with the clients for me. I really love being proactive with my clients, reaching out to them on the front end to ask, hey, what do you got going on this year? What have you been doing? Because, I could preach all day about how I tell everyone on the podcast or listening to this right now, reach out to your CPA, be proactive, make sure you reach out to them before making a decision on a transaction. To be quite honest, that just doesn't happen all the time, right? So if you have a combination of a client being kind of proactive, and then if the CPA is proactive as well, a lot of times if I'm just, reaching out and touching base with you from time to time, I'll be like, Brady, what do you have going on? And we're like, oh, well, now that you ask, I'm thinking about buying this real estate property out in Florida. How can you help me out with that? And I'm like, okay, well, let's talk about that and what the tax implications are going to be of that transaction. So, at the same time, it's just great, reaching out and developing that relationship. And, if you develop a personal relationship with your CPA or vice versa, the CPA with the client, I feel like you're more likely going to have them reach out and talk to you and just overall provide a better level of service.
And I think people have this image of CPAs in their mind that they're not social. They're behind this desk with one of the little green hats on back there, just churning numbers. And that's not what you do.
Well, you do have some of those types, but I'm not one of them.
So we're kind of wrapping up here. So I've got a few other questions.
Sure.
What are the biggest mistakes you do see as you're going through returns or talking to clients on real estate specific that people are making, or maybe on purpose or not on purpose? What are the mistakes you see, and how can you avoid them whenever you're coming in to file your returns?
Okay, so
or just with real estate, with your real estate investments in general, not necessarily returns.
Yeah, no, that's a great question. I think one of the things that I've seen of lately is that I have a lot of clients that they're about to be wrapped up with a sale transaction on their real estate, and they don't understand the tax implications on the sale of real estate. And as you and I have discussed before, when you're selling real estate, there's you can break that up into between short-term and long-term gains. And if you don't understand that, okay, if you bought a property, you got a really good deal on a property and you sold it 9 months later for a $200,000 gain. Well, you may think that you're getting long-term treatment on that because I would say a lot of property and a lot of real estate owners mostly sell their properties outside of that year holding period. So
Sure.
a lot of real estate is taxed at long-term capital gain rates. Well, if you sell that within a year, you're going to have short-term gain treatment, and it's going to be taxed at your ordinary income rates.
So you get hammered on it.
You get hammered on it. And so, whereas, if you hold it over 1 year, you get long-term capital gain treatment, which is generally 15%, 20% if you're in like a higher tax bracket. But
obviously all this stuff it's not the same across every client, right? Because sometimes it might be worth it to take the gain if you have losses. So it's looking at the whole picture if
you have a good deal that you can't pass up, it doesn't matter. But getting with the CPA to plan from a tax standpoint, like you're going to have this big influx of cash come in. Don't go spend it all because you're going to owe taxes on it. So put some aside, and the CPA can help you, and show you how much of that you should put aside for taxes when it comes time for paying it in April.
Well, Tony, I'm so glad you came on. I always ask everybody this. So you lived in Fort Worth for a while. Now you're in Dallas. So tell me some of the stuff you loved about Fort Worth, and just for anybody listening, what do you love about Dallas too?
Well, every time I talk to somebody about this, I always tell them when I lived in Fort Worth, it really it really felt like a small town with a small town feeling, but I was in a big city.
Yeah.
And I really love that about Fort Worth, and I think that they've got a really good reputation for that. And many times
that's been the same thing. Like every single person that's on here.
How many times had you and I gone out and we saw people out at either restaurants or bars that we knew, and I'm just like, I've been here for a year and a half, and I go out and I see people that I know.
Yeah.
It's that's kind of the feeling you get. You don't really get that much in Dallas, but the thing that I absolutely love about Dallas is the food is amazing. There's always new restaurants coming in. The culture is great. I feel like Dallas is a really kind of hodgepodge of people from all over the U.S. coming in. And it's just, I think the Metroplex as a whole is growing tremendously, and this is such a good market to be in, and I couldn't ask to be in a better place for my company and for my clients as well.
Yeah, that's great, Tony.
Mm-hmm.
Well, thank you again for coming in. Guys, this was another episode of Real Talk with Reside. Tony, if anybody wants to reach out to you and get a hold of you, how can they contact you?
So you have my contact information as well, but you can go to our website at www.dpllp.cpa. You can find my contact there under the, I believe it's Our Team tab. And just feel free to reach out with questions, anything like that. I'm happy to set up a call to discuss.
And again, guys, he doesn't just do real estate, so he can help you in all different types of industries.
Exactly.
Tony, thank you again. Really appreciate it. Thank you all for listening. And as always, please reach out if you have any questions or our team can help you in any way.
Thanks, Brady.